Hey everyone, and welcome to This Explainer. Today, I'm putting on my financial advisor hat to help you, especially if you're a relatively new investor, look past the initial hype of one of the market's absolute most popular funds. We're talking about the Vanguard Information Technology ETF, better known by its ticker symbol, VGT. You know, when we hear the word technology, we instantly think of the future, right? We think of massive, explosive growth and those giant household names that literally dominate our everyday lives. But here's the thing. Investor expectation rarely matches the mechanical reality of a financial product. So we're going to demystify VGT together and see exactly what you are actually buying when you hit that invest button.
Okay, so here's our quick consultation itinerary for today. We'll be running through the tech sector allure, looking under VGT's hood, the missing tech giants, the concentration risk, understanding sector risks, and finally, your investment takeaway.
All right, part one, the tech sector allure. Why everyone is watching VGT. Let's start with exactly why this fund caught your eye in the first place. Because, honestly, the initial stats are incredibly compelling for anyone hunting for high growth. There's a very good reason over $120 billion of investor money is sitting in this specific fund.
First up, let's talk about the expense ratio. It's sitting at just 0.09%. As you probably know, the expense ratio is just the annual fee the fund charges to manage your money. So at 0.09%, you're literally paying just $9 a year for every $10,000 you invest. That is incredibly efficient. It basically means you get to keep almost all of your compounding returns instead of handing over hefty management fees to some Wall Street firm.
And oh man, speaking of returns, VGT boasts a staggering 21.4% annualized return over the last 10 years, as of March 2026. To put that into perspective, your standard, average, broad market index fund usually historically returns somewhere around 8 to 10% a year. So seeing a sector consistently double that historical average? Yeah, that's exactly what draws aggressive, growth-focused investors right to VGT like a magnet.
Plus, there's a recent development. Vanguard completed an 8-for-1 stock split for VGT effective April 21, 2026. Now, a stock split doesn't change the actual underlying value of your investment. It's kind of like slicing a pizza into 8 smaller slices instead of one huge one. But it totally makes the individual shares much cheaper to buy. That makes the whole fund way more accessible to everyday retail investors who maybe didn't have the cash on hand for a single share at the old, much higher price. So combine the low fees, those massive returns, and this new accessibility, and the excitement around this ETF makes total sense.
Moving on to part two, looking under VGT's hood. What are you actually buying? As your advisor for this explainer, my job is to pop the hood and show you the actual engine in this vehicle. Because when you buy a thematic ETF, the label on the tin doesn't always tell the whole story, you know?
So let's break down what's inside. VGT currently holds 324 different stocks. On paper, that sounds fantastic. It sounds incredibly diversified, right? Well, not quite. VGT is heavily market cap weighted. That means the bigger the company, the larger the chunk of your money goes straight to it. Because of this, nearly 45% of your entire investment goes to just 3 companies. NVIDIA at over 18%, Apple at almost 16%, and Microsoft at just over 10%. The other 321 companies, they're left fighting for the remaining 55%. You aren't really buying 324 companies equally at all. You're basically placing a massive bet on a big 3. Which brings us to Section 3, the missing tech giants. It's really a matter of categorization. The surprises under the hood don't actually stop with that heavy concentration. There are also some frankly shocking omissions that catch a lot of newer investors totally off guard. You see, you might naturally assume a broad tech ETF holds every single major household name in technology, but VGT is what we call a pure play tech fund. It's tied strictly to the Global Industry Classification Standard, or GICS, and because of these super rigid industry rules, you completely miss out on giants like Amazon, Meta, Alphabet, Netflix, and Tesla. Wait, why? Well, because the stock market technically categorizes Amazon and Tesla as, believe it or not, consumer discretionary, while Alphabet, Meta, and Netflix get lumped into communication services. So if you're buying VGT thinking you're grabbing the entire modern tech landscape, you're actually leaving out half of the absolute heaviest hitters.
Let's jump to Section 4, the concentration risk. High reward, high vulnerability. This extreme top heaviness with NVIDIA, Apple, and Microsoft, paired with those strict sector limits we just talked about, lead us directly to the most absolutely crucial discussion we're having today.
Under the Investment Company Act of 1940, VGT is legally classified as a non-diversified fund. When a fund invests a massive percentage of its assets in a really small number of issuers, it loses that protective safety net of broad diversification. What this means for your hard-earned cash is that a bad day for literally just one stock, say Nvidia or Apple, facing a sudden supply chain crisis, drastically and immediately impacts your entire VGT portfolio.
The financial analysts over at The Motley Fool really hit the nail on the head here. They noted that having 3 companies account for over 45% of a 314-stock ETF is absolutely a high-risk, high-reward game. Sure, this immense concentration fueled unbelievable gains during Nvidia's massive run lately, but the exact cause of those gains is also the fund's biggest Achilles heel. When the top 3 soar, you look like an absolute genius. But if those specific 3 stumble, the other 300-plus companies just do not have the mathematical weight to keep your portfolio afloat.
All right, Section 5, Understanding Sector Risks. Time to read the fine print. To truly figure out if this fund fits your own overall strategy, we need to translate Vanguard's own legal risk warnings into plain English.
We really need to talk about historical volatility. Aggressive funds like this experience extremely wide and sometimes downright painful fluctuations. For example, VGT once plummeted over 21% in a single 3-month period. Now, conversely, it's also surged over 25% in a 3-month window. But as an investor, you really have to do a gut check. Do you have the emotional fortitude to watch a fifth of your investment just vanish in 90 days without panicking and selling? Because of this severe, whiplash-inducing volatility, Vanguard explicitly gives this fund a 5 out of 5 on their internal risk scale. That is their most aggressive rating. It stems from heavy reliance on a single sector that constantly faces unique headaches: rapid technological obsolescence, super short product life cycles, expiring intellectual property rights, and intense government regulations shifting all over the world.
And Vanguard's prospectus goes even further, warning of specific systemic hazards. The biggest one you need to wrap your head around is index investing risk. Remember, VGT is passively managed. It just blindly tracks a list of stocks. That means if the tech sector starts crashing, there is no active fund manager at the wheel to swerve your money into safer, boring assets like utilities or healthcare. You are strapped into the index and you have to ride the tech sector all the way down.
Finally, Section 6, your investment takeaway. Proceed with knowledge. So, after all of this, popping the hood, checking the engine, reading the fine print, what's our actionable takeaway from this explainer today?
Before you even think about pressing buy on VGT, I want you to walk through 3 quick steps. Step 1, check your current portfolio. If you already own an S&P 500 index fund, well, you already own a whole lot of Apple, Microsoft, and Nvidia. Buying VGT might accidentally double or triple your exposure to just those 3 companies. Step 2, decide if you're perfectly fine missing out on Alphabet, Meta, and Amazon, or if you need to buy them separately to feel truly invested in tech. And Step 3, honestly ask yourself if your timeline and your stomach can handle a level 5 maximum risk rating.
I want to leave you with this final, vital thought to chew on as you build out your financial future. When you look at VGT today, are you truly buying broad, sector-wide technology diversification, or are you simply making a highly concentrated, incredibly potent bet on 3 massive players? Seriously, before you make your next trade, go check your portfolio. Find out exactly how much Nvidia you really own. There is absolutely no wrong answer here, provided you know exactly what you're buying. Thanks for joining me for this explainer, and as always, keep learning, keep questioning, and keep investing wisely. Catch you next time.